Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within corporate filings. Today we're diving into a report that might feel a little like a DJ vu for some companies, dealing with some classic stock market challenges. Get ready for Classover Holdings Incorporated, and their latest filing that sheds light on a very common issue for companies navigating the stock exchange. We will explore what this news means for their investors and their future on the Nasdaq. Before we dive in, if you enjoy getting these straightforward breakdowns of complex financial documents, make sure you are subscribed. Also, we have a growing community on Discord linked in the description below where we discuss these insights further. This is a Form 8K report, which is like a company's immediate announcement service to the public. It is for reporting major events that shareholders absolutely need to know about right away. And for Classover Holdings Incorporated, the event reported is quite significant. The earliest event reported here happened on the 21st of November, 2025. Now, what exactly occurred on that date that warranted such an urgent filing? It all comes down to a notice from the Nasdaq stock market, the very exchange where Classover Holdings Incorporated stock is traded. The company has two main types of securities listed. There is their Class B common stock, which is essentially ownership in the company. And then there are redeemable warrants. Think of these as options to buy the company's stock at a certain price in the future. In this case, $11.5 per S-share. The core of this report, the big news, is about a notice regarding their continued listing on the Nasdaq. This is essentially a warning that they might be at risk of being delisted, meaning their stock could be removed from the Nasdaq exchange. Here is the specific problem. For 30 days in a row, the stock's price, or more precisely, the highest price a buyer was willing to pay, had fallen below $1. The Nasdaq has a rule, Rule 5550R2, that requires listed companies to maintain a minimum bid price of at least $1. Now, it is not an immediate disaster. Nasdaq is giving Classover Holdings Incorporated a grace period. They have 180 days until May 20th, 2026 to fix this. To get back into compliance, they need their stock price to be at or above $1 for 10 consecutive business days. This is a common way for companies to show sustained stability. And if they can't manage it in the first 6 months, there is a possibility for an extra 6 months. But this second chance comes with conditions and requires the company to meet specific criteria, which aren't detailed here, but are usually about demonstrating concrete steps towards improvement. The ultimate consequence of not meeting the requirements is delisting. This would significantly impact the stock's liquidity and attractiveness to investors. For now though, there is no immediate disruption. The stock will continue to trade on Nasdaq under its ticker symbols KIDS for the common stock and KIDSWOL for the warrants. This grace period is crucial for them to strategize and execute a plan to boost their stock price. It is worth noting here that Classover Holdings Incorporated is identifying itself as an emerging growth company. This status often comes with regulatory flexibility, as we see with the extended transition periods for financial accounting standards. However, it doesn't exempt them from basic listing requirements like maintaining a minimum stock price. Now, like many companies, they include a cautionary note about forward-looking statements. These are basically statements about what the company hopes or expects to happen in the future. They're included to protect the company legally if future outcomes don't match these expectations. The key takeaway here is that these are just predictions and actual results can, and often do, differ significantly. They're essentially saying, don't bet your life savings based solely on what we're saying about the future because things can change. Now, let's shift gears to what this situation implies more broadly. Facing a minimum bid price deficiency is a signal. It indicates that the market, for whatever reason, is not valuing the company's stock at $1 or more consistently. This could stem from various factors. Perhaps investor sentiment is low due to recent financial performance, concerns about future growth prospects, or broader market conditions affecting smaller or growth-oriented companies. The company now has a clear objective: boost investor confidence and consequently the stock price. They might consider strategic maneuvers like a reverse stock split, where they consolidate existing shares into fewer, more valuable ones. While this artificially inflates the per-share price, it doesn't inherently change the company's overall market value. It's often a cosmetic fix to meet listing requirements, and investors are usually aware of this tactic. Another strategy could be to drive actual business improvements that lead to a higher valuation. This might involve strong earnings reports, successful product launches, or strategic partnerships. For Classover Holdings Incorporated, the challenge is to not only meet the $1 mark, but to do so sustainably, demonstrating a genuine improvement in their business health. The risk here is obvious. If they fail to bring their stock price up, they could be delisted from Nasdaq. This would mean their shares would likely trade on over-the-counter markets, which are generally less regulated, have lower trading volumes. and can be more volatile. This also makes it harder for institutional investors to buy their stock, potentially limiting future funding opportunities. On the flip side, a successful turnaround and regaining compliance could signal resilience and a newfound momentum. Investors will be watching closely to see if the company can execute its plan effectively and rebuild market confidence. So, what is the verdict on Classover Holdings Incorporated based on this filing? Right now, the company is on notice, facing a common but serious challenge on the Nasdaq. The 180-day clock is ticking, and their ability to navigate this period will be a critical test of their management and their business strategy. The key will be whether they can implement real, value-driving changes rather than relying solely on cosmetic fixes to satisfy the listing requirements. Alright, so that's our breakdown of Blackridge Holdings Incorporated's latest filing. What is your take on their situation, and do you think they can turn things around? Drop your thoughts in the comments below. If this analysis was valuable to you, please hit that like button and subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community, linked in the description, for more real-time discussions. Thanks for watching, and we'll see you in the next Decode.